Hi, I'm James Nelson, Vice Chairman at Cushman & Wakefield. I'm here to bring you the Nelson Report's February 2017 video exclusive. Let me first give you a quick wrap-up of 2016, and then let's talk about 10 tips for successful investing this year. So volume overall was down nationally and in New York City last year, but prices actually went up. So if you look at the U.S., we saw that there was a total of $489 billion, which represented an 11% decline last year, but pricing actually went up 9%. Interestingly enough, the same phenomenon held true in New York City, where we had a total of $57.8 billion, and for those of you keeping score, that was the fourth most sales on record, but that still represented a 25% decline over 2015's record of $70 billion. Land, no surprise for most, was a decline of 75%. But here's the interesting part. Prices for existing buildings went up 9%, and caps went to an average of 4.16%, an all-time low. So you might be asking yourself, how are you going to go about investing this year if volume is down and pricing is up to all-time levels? Well, let me walk you through 10 quick suggestions. So, number one, value add. Value add is still king. You can't rely on cap rate compression these days to exit an investment. What you really need to do is increase the underlying fundamentals of the property by increasing that net operating income. Now, that could mean doing renovations. It could be increasing unit counts. It could be looking for that long-term retail lease that's about to expire. And so whenever you can improve the underlying fundamentals of the property, you're going to have a lot more cushion if this cap rate environment does not stay where it is. Number two, on retail, think small for retail. Now, if you look at the overall numbers in New York City, availability is now over 20% in some corridors. Asking rents are down across the board. However, there was actually more retail leasing activity in 2016 than there was in 2015. Now, a lot of that had to do with these smaller leases that were under 2,500 square feet. So no surprise that a lot of larger tenants in this more competitive e-commerce environment are looking for smaller stores. Again, there was almost a 30% uptick in the number of signed leases, which I think would surprise a lot of people, but you have to know where to pick your spots. Number three, for residential, beware of regulation. Now, the new rent guidelines that deal with rent regulation was really a blow to landlords. First of all, it's now virtually impossible to decontrol an apartment until the second turn. You also have a 0% frozen rent increase environment. And lastly, you've got the state coming in with a tenant protection union. So it's really for investors, unless this is really something that you do full time, I would be very cautious. For those investors who are still looking at regulation, I'd keep your eye out for long-term owners who don't want to deal with this hassle anymore. Number four, watch for concessions. Now, this applies for both residential and commercial. The net effective rents for office is actually down across the board because of more free rent and more TI. The same holds true for new construction residential, where some landlords are now giving 2 months free rent to get an apartment and they're paying the broker. So when you're looking to buy, you better be asking what type of concessions existed to get those rents and make sure that the collections are actually there. Five, the boroughs. The boroughs still have legs. If you look at, and I'm going to actually take an extra piece of paper for this, if you look at the averages by borough, if you look at Manhattan and what happened in 2016, average price per square foot was $1,450 a foot. Now, granted, a lot of that had to do with some of these very high-end retail sales, but look at Brooklyn. Brooklyn average was $422 a square foot. Queens, surprisingly higher than Brooklyn, and this has got to be a first time, at $491 a foot. Northern Manhattan clocking in at $421 a square foot. And the Bronx, you're at 222. So it doesn't take a genius to see the disconnect in value here, whereas in Brooklyn you can get 3 times, almost 4 times the amount of bricks in Manhattan, and in the Bronx it's quite a multiple of over 5 times. And if you look at the rent discount, it's in some areas of Brooklyn, you have residential rents that are now higher than some of the neighborhoods in Manhattan. So there is surely an opportunity here, because I think these boroughs, you see a lot more off-market transactions. There's less coverage in those markets, and as a result, I certainly see opportunity there. Okay, so boroughs, a lot of opportunity. 6, this is a pitfall to watch for, is prepare for rising taxes, and I should say real estate taxes. Under the current mayor, we've had over a 29% increase over his tenure in assessments. And so you see real estate taxes now making up as high as 25 to 30% of total revenue. When you buy a property which was just renovated and that income is yet to hit those RPIEs, you need to make sure that you brace yourself for tax increases. Now, there are some tax classes which are protected, and if you look at a class tax 2B, which applies to under 10 units, there the real estate tax increases are capped at 8%, so that might be a good strategy for you. Number 7, another good investment idea is build in what I'll call affordable condos. Now, when you talk about $7 million plus condos, which is still the luxury segment, there's close to an 8-year supply. I think many don't realize that there's only about 100 of those apartments that sell per year anyways. Meanwhile, in the $3 million and under, there is still only a few months supply. Now, there is some construction financing coming back online, so this could be a good time. I started off by saying that land declined by 75% in dollar volume in Manhattan. That means that there's going to be a big void in the next few years for new condo development, certainly in this what we'll call affordable category. Number 8, look beyond Midtown South. And this applies for office. There's so much attention to this area. Vacancies now, almost at a national low at 6%. But for a converted building, you could see rents at over $80 a foot, and new construction over $100. There's value in downtown Manhattan where rents are considerably less, and even in Midtown, we can see certainly along that 3rd Avenue corridor rents at a steep decline to Midtown South. So I would encourage you all to look for value in some of these other neighborhoods. Number 9, almost there, is lock in 10-year debt. Now, since the election, we've seen 10-year treasuries go up close to 80 basis points, and as a result, interest rates where you're borrowing 5-year money is now in the high 3% range. For 10-year money, it's in the low 4s. The Trump administration, the Fed, they've already talked about 2 potential rate increases that are anticipated at 25 basis points each to compensate for where the current economy is. And so we could certainly see rising interest rates, and as a result, I would really look to lock in 10-year debt while you can. Now, 10 is make sure and watch what is happening with the Better Way tax reform. No one is really speaking about this, but the House has already put in front a proposal for treating real estate as an expense, not as a long-term gain. So I think a lot of the focus wrongly is on the elimination of the 1031. What you all have to understand is if we went to an expense-based treatment for real estate accounting, think about it. If you bought a building at a 5 cap, all cash, you could talk about sheltered income for the next 20 years. This would have a major impact. I've heard people say even maybe it's too much of a good thing and could be a return to the 80s, but definitely something to watch, because if that happens, there's going to be major benefits in the near term for real estate. So that's it for this month, and happy investing this year. Hopefully you can follow some of these tips and find some opportunities there. Thank you so much.